Hi, everyone. Welcome back to another session on strategic financial management. So during the previous lectures, we learned about cost accounting. I gave you a brief introduction to cost accounting. We learned a few definitions of cost accounting. And today, in this session, we're going to learn about the classification of costs. What are the classification of costs? How are costs classified? Costs are classified under 8 categories, right? Costs are classified under 8 categories. Number 1, by time. Number 2, by nature of elements. By degree of traceability to the product, association with the product, by changes in activity or volume, by function, controllability, cost for analytical and decision-making purposes. So cost accounting or classification of costs, they are divided, and you know there are more categories, but these are the most important categories, and we're going to have a discussion on that today. So first, we're going to learn about historical cost and predetermined cost. What are historical costs and what are predetermined costs? Now, historical cost, these are the actual costs that have been incurred in the past, right? So meaning these costs are ascertained after they are incurred, right? Some cost has already been done. It's finished. For an example, if an organization bought a machine for $100,000 or £100,000 last year, right? Say in 2024, company, say ABC company purchased a machine worth of $100,000. When did this happen? 2024. Now, this is a historical cost. This is a historical cost. And then you have predetermined cost. What is predetermined cost? Predetermined cost, these are the costs that are calculated before they are incurred. Historical cost, these costs are ascertained after it has incurred. Predetermined cost, these costs are calculated before they are incurred, right? Before they are incurred. So these costs are also called as estimated costs because you don't know the actual amount, right? You don't know how much it's going to cost. So you're estimating, you're making assumptions. So estimated costs or predetermined costs are usually used for budgeting or forecasting in organization. This is predetermined cost. So under time, under the category of time, costs are divided into 2 categories. Number 1, historical cost. Number 2, predetermined costs. Now we're moving on to the next category, by nature of elements. By nature of elements. By nature of elements, this is divided into 3 categories. Again, material, labor, and overhead. We have material, labor, and overheads. So let's see what material is about. Material means these are the raw materials or ingredients that are directly or indirectly used for the manufacturing or production of a product, right? So material means these are the costs related to raw materials used in product. This cost is further divided into 2 categories, which is known as direct and indirect. So material, you have 2 more categories, which is direct material and indirect material. What is direct material and indirect material? What is direct and indirect material? Who can tell me? I think I gave a brief explanation about it somewhere the previous sessions. I don't remember exactly where. Direct material, yes, someone wanted to say, yes?
Yeah, direct materials are the material which can be identified as the final product directly.
Mm, okay, yes, I'll take that as an answer. Yes, partly correct. So direct material refers to the materials which become a major part of the finished product. For an example, when you're planning to stitch a coat or a jacket, right? You need the fabric. You need the fabric to stitch it. You need the fabric to make the final product. And this fabric is the major part of the final product. Now, this is direct material, right? This is direct material. Why? The fabric is the major part of the jacket. If there's no fabric, there's no jacket. Therefore, this is a direct material, right? This is a direct material. What is an indirect material? Indirect material means, example, say, yes, now you have this stitching or the sewing machine. Now you might use oil, right? You might use oil to repair or to fix certain issues in this sewing machine. Now oil becomes an indirect material. Why? Is it a major part of the final product? Do you see it anywhere in the final product? No. But do you need it to prepare the final product? Yes. This is indirect material. Clear? So under material, you have two classifications, which is direct and indirect. Labor, same. Labor also you have direct and indirect. So labor cost, this can be classified, further classified into two, which is again direct labor and indirect labor. Right, what is direct labor? Who can define direct labor? I'm going to go at a slower pace because this lesson is very important for you, especially for your assignment, your third task. So I'm going to take it very slow. So what's the meaning of direct labor? Easy, same definition as direct material. The only difference is that this is labor, that is material, right? So direct labor can be defined as for an example, the wages that you pay for the worker, right? Not the person who is going to sell your product in the shopping store, not her. The one who is teaching, right? The one who is teaching, you're going to pay a wage or a salary. Now, this is direct labor. Why? Because she's directly involved in producing the final product. Without her, there will be no output. Without her, there will be no output. Therefore, she is a direct labor. What is indirect labor? The other laborers who are employed for the purpose of carrying other responsibilities. For an example, you've prepared the jacket, you've made the jacket, now you need to sell this jacket at a clothing store. You need a sales assistant. Now she becomes the indirect labor. Clear? So salaries or wages that is paid to her, the sales assistant or the sales representative, she is the indirect labor. Clear? And then you have overheads. Now, what do you mean by overheads? Overheads means the other costs that are not directly tied up with the production process. Directly, not directly tied up with the production process. So here, rent, utilities, electricity bill, this come under factory overheads. Clear? So by nature of elements, it is divided into three categories: material, labor, overheads. Sorry. Material is further divided into two categories: direct material, indirect material. Labor is further divided into two categories: direct labor and indirect labor. And then you have the overheads. So this is a classification based on the nature of the elements. Let's move to the next slide. Ease of traceability. Ease of traceability. This is divided into two: direct and indirect. Now, this is the summary of what we learned here. Yeah, the summary of what we learned here. What are direct costs? The direct costs are the costs that can be easily traceable to a product or a costing unit or cost centers. Remember, we learned about cost centers in the previous session. So I'm not going to define it again. So direct costs are those which can be easily traceable to a product or costing unit or cost center. Indirect, exact opposite. Now, the indirect costs are difficult to trace to a single product or a costing unit or a costing center. Right? So this is direct and indirect. And now we have association with the product. Association with the product costs and period cost. What do you mean by product cost and period cost? Product cost means these are the costs that are traceable to the product and included in the inventory values. So product costs includes the costs of direct material, direct labor, and manufacturing overheads. Direct material, direct labor, and manufacturing overheads. Now, this is the product cost. So if any cost is related to producing the product, then it becomes product cost. Now, here, as you can see, we are preparing a burger, right? A bun. So to prepare the bun, we need flour, we need yeast, some salt, some filling, some water, right? So these, all the money that is spent in purchasing these products or these raw materials are called as product costs. This one, this one, this one, this, and this one. So the combination of all these elements will give you this output. Therefore, these costs, the money that you spent in purchasing these raw materials, they are known as product costs. Next, we have period costs. Now, period costs are the costs that are incurred on the basis of time, like rent, salaries. That can also include selling and administrative costs, right? Period costs. Again, you can say period costs are the costs that are not directly tied to the production or to the product. So advertising expenses, right? Once you make the burger or the bun, you need to sell it. You need to advertise this. For an example, use a brand name, right? You need something, right, to go out to the market. So all the money that is spent in launching the product, in advertising the product, this is called period costs. Again, electricity, rent also comes under period costs. So this is association with the product. And next we have behavior in accordance with the activity. Behavior in accordance with activity. So the three categories in here. We have fixed costs, variable costs, and mixed costs. Fixed cost, variable cost, mixed cost. What are fixed costs? Who can define the term fixed costs? As I always tell you, when you see two words, okay, break it down. Fixed cost. So what do you mean by fixed cost? Who can explain? Nobody? Okay, this is a boring class. Someone volunteer. Yes, exactly. That is correct. The cost that does not change, or the cost that remains constant regardless of the production level. Now, fixed cost, I explain or I define fixed cost like a stubborn person. Like he is stubborn. No matter what's happening around him, he doesn't want to change. Right? He doesn't want to change. He is fixed. So things can change around him, but he is not ready to adapt to it. This is fixed cost. Right? This is fixed cost. For an example, say for an example, in January, the organization produced, okay, let's see, the rent that you pay for January is £1,000. Say a production room, a small room, and you're producing the product here and you're paying £1,000 for this particular room. So January, you produced 1,000 units. And for the month of January, you pay the rent of 1,000. Right? February, you produce 2,000 units. Does this mean that your rent is going to increase? No. So even if you produce 2,000 units, you still pay £1,000. In March, you produced 5,000 units. Does it mean that you're going to double the rent? No. So no matter what happens, even if the production units increase or decrease, fixed cost remain constant. There are exceptions, right? There are exceptions. There are certain circumstances where this will not be true. But in the majority of the cases, fixed cost is fixed. It is remaining constant. It does not change. It is stubborn. It doesn't want to change. So remember fixed cost as a stubborn person, right? A person who doesn't want to change. Next, we have variable cost. Now, variable cost is a friendly person, right? Variable cost is a friendly person. What does that mean? When things around this person change, he or she will adapt to the changes. So variable costs are those costs that vary directly and proportionately with the output. This is variable cost, right? So these are the costs that change with the level of production or activity. So when the production level increases, the variable cost changes. When the production level decreases, the variable cost changes. So it adapts to the environment. Variable cost, as I told, friendly person. Next, you have mixed cost. Now, mixed cost is a cunning person. Why? Mixed cost is a cunning person because mixed cost has the qualities of both variable and fixed cost, right? Mixed cost has qualities of both variable and fixed cost, right? So fixed cost, this part of the cost that doesn't change, and variable component, the cost that changes. For example, I can say, the example that I can give you is the Wi-Fi or a telephone bill, right? Okay, let's take the Wi-Fi. So the Wi-Fi that you use, it is a package. Yeah, you usually pay for a package. Say for an example, 100 GB. For 100 GB, you pay, say, 2 access. For 100 GB, you pay 2 access. This is a fixed amount. So January, February, March, you use 80 GB, you use 70 GB, you use 50 GB, or you use 100 GB, doesn't matter. You have to pay XX, right? But what if you exceed the 100 GB? Now 100 GB done, and you're still at the 25th of the month. Now you need to survive for another 5 days. Can you survive without Wi-Fi? No, you need Wi-Fi, right? You cannot survive without it. You need it. How can you do your work, your office work, your assignments, which you love to do? You need Wi-Fi. Yes? So now what do? You purchase more GBs. Now here what happens? You need to pay extra. Will the Wi-Fi or the Wi-Fi provider, the service provider, give it for you for free? No, you have to purchase it. So you're going to purchase extra GB. Say you're going to purchase 10 GB more. Now to purchase this 10 GB, you need to pay more. So 100 GB is the fixed quality, and this 10 GB becomes the variable quality. Combination of both is the mixed cost. Is it clear? Now we have function. Function, we have manufacturing costs, selling and distribution cost, administrative cost, research and development cost. Let's see what manufacturing cost is about. Manufacturing cost. Manufacturing cost, this is the cost of operating the manufacturing division of the organization. So it includes the cost of direct materials, direct labor, direct expenses, and all the cost that is directly related to the production of the product comes under manufacturing costs, right? And then you have selling and distribution cost. What do you mean by selling and distribution costs? Selling and distribution costs means any cost that is related to selling, right? Maybe advertisement, market research, distribution costs like packaging the product, right? Packaging the product, warehousing, right? So all these come under selling and distribution costs. So any cost that is related to sales or selling a product come under selling and distribution costs and distributing the product. And next you have administrative costs, right? Administrative cost. What do you mean by administrative cost? What do you mean by administrative costs? Easy. Administrative costs are the costs that is related to the administration. So these are the costs that is incurred in formulating the policies of an organization, controlling the operations of the organization, right? This is coming under administration costs. And next you have R&D, research and development. Research and development cost. Now these costs these costs includes examples such as discovering or innovating a new product or process, discovering a new product, a new idea, a process that comes under R&D, research and development costs. And next you have controllability. Controllability. Here you have two categories, controllable costs and non-controllable cost. Controllable cost and non-controllable cost. What do you mean by controllable cost and non-controllable cost? Now, controllable cost means these are the costs that can be controlled by an organization at a certain level, right? So a controllable cost can be controlled by the organization at a certain extent, or to a certain extent rather, right? This is controllable cost. Non-controllable cost means these are the costs that cannot be influenced by the decisions of a particular department. Controllable costs, these costs can be influenced, right? These can be influenced or controlled by a specific level of management. For an example, a department head can control the labor costs by adjusting the working hours of this particular labor. This is controllable. Non-controllable means the tax that you pay to the government. This cannot be controlled, right? This is an example for non-controllable costs. And then you have relevance to decision making. Relevance to decision making, you have opportunity cost, relevant cost, sunk cost, and imputed cost. Now, what is the meaning of opportunity cost? Now, you might see, why is this slide with 3 beautiful girls? Who can tell me what is the meaning of opportunity cost? Now, this is a term that you would have learned in business studies as well as economics. You use this term in economics a lot. What do you mean by opportunity costs? You can just define in simple words. It's okay. Anyone who can help me with this? What do you mean by opportunity cost? Okay. Who's not married yet? Can you all raise your hands? Who's unmarried? Or you can type a message privately if you're uncomfortable in revealing it in public. Just type 1 on a private message. Okay. Oh, this is single, or maybe not single, I mean unmarried. I'll use the word unmarried. Okay. Okay. Who else? That's it? The rest of them are married. Ahsan, you're not married yet, right? Okay, so I'm gonna take Akhtas then. I'm gonna take Akhtas and Shanuta. Okay, Akhtas. So I'm gonna give you the choice of no. Let's say something like this. Okay, I want you to choose one person out of these 3. Who would you choose? Okay, I'm gonna name. I think it's better if I can name them, right? A, B, and C. Okay, let's see. Akhtar's parents are looking for someone, right? Looking for someone to him, a match to Akhtas. And I will say Shanuta as well. I'm going to take Shanuta as well for this experiment. Just hypothetically, okay? It's all hypothetical, just for you to explain. I just want to explain this particular thing, opportunity cost. So your parents have found 3 matches. All 3 are pretty. All 3 are good. And they're very compatible. All 3 of them are compatible, right? All 3 of them are compatible to you, right? So, Akhtas, whom would you choose? A, B, or C? Sorry, who would you choose? A. And Shanuta? How about you? Oh, okay. Both went with the choice A. So my point here is, what I want to say is, you had the option of choosing any of them. But what was the condition? You can only choose one, because you can only get married to one, not all 3. So what happens here is, when you choose A, you need to let go of B and C. Right? You need to let go of B and C. Now, this is opportunity cost. The cost of foregoing the next best alternative when making a decision is known as opportunity cost. Right? Is known as opportunity cost. I remember in one of the lectures, one student was like, "Oh, no problem. I'll choose all 3. I can manage all 3." I remember. I don't remember particularly which batch, but I remember one student saying this. But the condition is, you can only choose one, not the others. So this is opportunity cost, right? Next, we have relevant cost. We have a relevant cost. What do you mean by relevant cost? Relevant cost means this costs incur or it is only related to a specific management decision, right? A relevant cost is a cost that is only related to a specific management decision, meaning there is a cost when you make a decision, or the cost is incurred because of the decision you made. This is relevant cost, right? This is relevant cost. An example for relevant cost, I can give you, meaning, okay, again, I'll explain. Relevant cost is a cost that will be directly affected by a specific decision of the organization, right? Okay, let's say you have the option of choosing, okay, you have two suppliers, right? You're planning to choose one supplier to supply raw materials to you, and you have, or the company has to decide between two suppliers, right? So one supplier charges $10 per unit, $10 per unit. And then you have another supplier or a potential supplier, right, that you're planning to, deciding to go with, or you're looking for someone, a new supplier. Now he will be charging $8 per unit, right? But he has a condition. He says, I want you to, or he offers a one-time setup cost of $1,000. Now this is a relevant cost, meaning if the company selects the new supplier, or if the company shifts from the current supplier to the new supplier, then a cost is incurred, which is $1,000. This is relevant cost, right? This is relevant cost. Another example that I can give you is make or buy decision. Remember, we learned in our first or second session, make or buy decision. This is a relevant cost, right? This is a relevant cost. Next, you have sunk cost. Next, you have sunk cost. What do you mean by sunk cost? Sunk cost means this is a cost that has already been incurred. Sunk cost means a cost that has already been incurred and cannot be avoided by decisions taken in the future. This is a sunk cost. Next, you have imputed cost. Now, this is a very interesting cost, right? This is a very interesting cost. Now, imputed cost means, I'll explain it with an example, but let me first define the term imputed cost. Imputed cost means a cost that is not actually incurred, but it is used for decision making, right? Meaning it is hypothetical, right? Imputed costs are hypothetical. It does not involve a cash outlay. Imputed costs are hypothetical costs, right? Imputed costs are hypothetical costs. For an example, this boy, let's name him Andy, right? So Andy decided to go to a graduate school and get his degree, complete his education and get a degree instead of working at a job, right? So Andy, he had a choice of getting a job and getting an income of, say, how much? Let's say 4,000 pounds, right? As a start, as a beginner. So he had the choice of getting a job and getting an income of 4,000 pounds, or he had the choice of getting into a graduate school and completing his degree. So if Andy decided to go to a graduate school instead of working at a job, the imputed cost would be what? The salary that he gave up during the time he spent at the college. So if he spends 1 year, right? If just imagine he spends 1 year at the college. So 1 year, meaning 12 months into 4,000 will be the imputed cost. Did he actually lose it? Did cash really go out of his pocket? No, it's hypothetical. So imputed costs are the costs that are considered by the organization when making decision, right? When making decision. So did it really happen? Did really cash go out of out of pocket? No, but just hypothetical, right? But this is really important in decision making of the organization. Clear? So we've covered it all. We learned about historical cost, predetermined cost, nature of elements. We learned about material, direct material, indirect material, labor, direct labor and indirect labor. And then we learned about overhead cost. And here we learn about direct cost and indirect cost, product cost, period cost, fixed, variable, mixed, manufacturing, selling and distribution, administrative cost, research and development, and under controllability, controllable cost, uncontrollable cost, and opportunity cost, relevant, sunk cost, and imputed cost related to decision making. And now let's look into the importance of cost accounting. Number one, useful in periods of depression and competition. Useful in periods of depression and competition. During trade depression, the business cannot afford to have any leakages. So the managers should know where economies may seek waste eliminated and efficient, meaning they have to find out, okay, they must be able to use the resources effectively and efficiently without any wastage during the periods of depression, right? Next, helps in pricing decision. So cost accounting helps in pricing decision. What does this mean? Helps in pricing decision. Helps in pricing decision. What does this mean? You know that the market, the economic law of supply and demand, right? Supply and demand. So through cost accounting, they're able to analyze and decide on the price, determine the price of a product. Next, help in estimates. Helps in estimates. So cost recordings provide a reliable basis upon which tenders and estimates you can prepare based on these costing records. You can prepare tenders and estimate an amount based on the costing records. So the chances of losing a contract or a bid is less. So this is another advantage or another importance. Next, cost accounting helps in channelizing productions on the right lines. Now, costing makes it possible for the management or the organization to distinguish between profitable and non-profitable activities. Next, costing results in increased efficiency. Yes. So when you're analyzing the costs of the materials, cost of the operation, you will be able to find out, okay, there are certain wastage that is happening. So through the analysis of costing methods, you will be able to find out these are the areas that the company is incurring losses, and you can fix it. Next, costing helps in inventory control and cost reduction. Costing furnishes control which management requires in respect of stock of materials, work in progress, and finished goods. Now, inventory control, right? Here, we're going to learn three terms: stock of materials, right? Raw materials. Work in progress. Work in progress means half finished goods or semi-finished goods. Now, out of 100%, maybe 30% is done, 40% is done, 50% is done. These goods, you call it work in progress, right? It's still what do you call? Still in the process of happening. And then you have the finished goods. Finished goods means completed products. So costing helps in inventory control and cost reduction. And finally, costing makes comparison possible. If the costing records are regularly kept, comparing the cost of last year, the costs incurred last year, and the costs incurred this year can be compared. Not only years, even months. So comparing the costings for different periods can be done if you have a clean record of costs. So costing makes it easy, makes comparison easy. So these are some of the importance of cost accounting. Is everything clear? Does anyone have any questions? All good? All good? Okay, great.